Hey everyone, welcome to This Explainer. Today we're diving into something absolutely fascinating, a massive multi-year portfolio shift that's quietly happening among European family offices right now, between 2022 and 2026. We're literally watching a fundamental rewiring of how generational wealth is deployed. If you want to know where the global economy is heading, you don't just look at the public stock market, you look at where the ultra-wealthy are quietly parking their capital. So what does this all mean? Well, that brings us to the core mystery of our explainer today. While the rest of us and the broader market have been scrambling to react to rising inflation, interest rate hikes, and all this geopolitical turbulence, how are the billionaires navigating the storm? What exactly is the smart money doing right now to not just protect, but aggressively grow their wealth? Well, here is the smoking gun. European family offices are currently sitting on a massive cash reserve, an average of 14% of their total assets. To put that into perspective, that is nearly 3 times the 5% cash held by their North American counterparts. Honestly, it's a staggering difference. But here is the secret. This giant pile of liquidity, it isn't about market fear, not at all. It is strategic patience. It is pure dry powder, just waiting to be deployed into the absolute perfect risk-adjusted opportunities. Now, what's really interesting about this slide is how they're actively avoiding inflation traps by totally rethinking traditional safety nets. They're drastically reducing their fixed income duration. Actually, one principal from a Belgian single-family office put it super bluntly. They said they're happy to have zero exposure to bonds because holding zero coupon bonds in a rising interest rate environment just doesn't make any sense to them. They're completely tossing out that old 60-40 portfolio playbook. Section 1. Bypassing the middleman. So where is that massive 14% cash pile actually going? Well, they're structurally changing how they invest. Historically, families relied heavily on traditional private equity funds, but those come with that classic 2 and 20 model. You pay a 2% management fee and hand over 20% of the profits, not to mention those rigid, ticking clock life cycles. Well, European family offices are completely bypassing this old system through co-investments by investing direct capital right alongside lead sponsors to get incredible fee efficiency. Removing that heavy Wall Street fee drag just massively boosts their net returns. It's a real game changer. The CEO of a private multifamily office in the UK really hit the nail on the head here. They noted that their direct investments are now entirely co-investments. Basically, they do the deep due diligence on the manager, and when a deal makes sense, boom, they jump in directly. It's a brilliant way for families to preserve that long-term generational wealth compounding simply by keeping the profits that used to be swallowed up by middlemen. Section 2. The private market pivot. Okay, let's dive into this and track the specific asset classes soaking up all this newly liberated capital. A staggering 81% of these family offices say private debt and direct lending offer the absolute strongest risk-adjusted returns right now. See, because European banks have pulled back from mid-market lending, mostly due to strict Basel III regulations, there's this massive financing gap. So family offices are just stepping in and playing the role of the bank. They're capturing incredible direct lending yields of 11 to 13%, and often with senior secured structures that give them serious downside protection. They're also making huge plays in real estate, but with laser precision. 78% of European offices with real estate exposure are heavily focused on the residential sector. We're talking homes and apartments. They are, for the most part, avoiding the stagnant commercial, retail, and office sectors where the shift to e-commerce and remote work has really structurally damaged demand. They're sticking to the absolute fundamentals here. No matter what, people always need a place to live. And they're taking this whole philosophy global. European offices are increasingly looking at African venture debt markets. Now, unlike your typical institutional asset managers who are constantly driven by immediate liquidity pressures, family offices provide what's known as patient capital. Because they don't have the strict ticking clock of a traditional fund, they can give African portfolio companies the multi-generational runway they actually need to weather volatility and pull off long-term capital projects. Section 3. Betting on emerging tech. Beyond private credit and real estate, this smart money is flowing aggressively into the future. When you track where they intend to increase their allocations, it's pretty eye-opening. A massive 53% of family offices who are already in green tech are targeting it for their very next phase of capital deployment. And this is closely followed by healthcare tech at 46% and artificial intelligence at 37%. So they aren't just protecting their wealth, they are actively bankrolling the sustainable and digital transformations of the global economy. Section 4. The generational wealth transition.
Let's move to and see how this builds. Because why is this pivot happening right now? Well, it's driven by a massive demographic shift. Right now, vast fortunes are passing from the founding entrepreneurs directly to the next generation. Just tracking the timeline, 24% of offices reported a transfer of control recently, another 14% anticipate it in the next 5 years, and 19% in the next 10 years. That means a full third of this massive intergenerational wealth transfer is happening over this current decade alone.
So, the absolute crucial takeaway here is that as this next generation takes the reins, they are fundamentally rewiring how the family office operates. We're seeing the total institutionalization of family wealth. They're setting up these highly sophisticated platforms in regulatory safe havens like Luxembourg and Geneva. And maybe even more importantly, they are demanding rigorous sustainability metrics. For this new generation of wealth, aggressive financial returns and sustainable impact are definitely not mutually exclusive. They're increasingly demanding strong ESG credentials, like top-tier Article 9 SFDR classifications, as absolute non-negotiable preconditions before they even think about investing.
Which leaves us with a pretty profound realization. We are watching literally trillions of dollars in generational wealth shift away from passive public market allocations and into highly targeted, direct patient capital. As this new generation completely bypasses Wall Street to directly finance green tech, global real estate, and emerging market venture debt, we really have to ask, how will this massive transition of trillion-dollar wealth completely reshape the global economy over the next decade? It's an absolutely fascinating trend to watch, and one that is going to define the markets of tomorrow. Thanks so much for joining me for this explainer.